So let's review very quickly. First question here is from Denny. Here is our Iron Condor. Sold the 103 put and bought the 95. That's a bull put credit spread. There we go. This is our bull put credit spread of the Iron Condor. And then he did a 10-point spread on the bear call side by selling the 130, buying the 140. Lower break even, 102.32, and the stock is at 104.99. Upper break even, 130.68, not even being threatened right now. Okay, so the question is it time to do any management on this position, and what management should we consider? Now, in general, we have various videos in the webinar, archive webinar field, excuse me, Denny, on managing your bull put spread and some presentations on managing your bear call spread. I don't have a full webinar on managing the Iron Condor because I treat it the same. If I'm in an Iron Condor and my bull put side is being threatened, yes, I keep in mind, of course, what my original premium was, but at the same time, I'm focused on this. I'm going to manage the bull put the same way I would manage a standard bull put that was now being threatened had I opened it on WYNN. Excuse me. So, now that our spread has been threatened, I apologize. First off, what are my triggers? The discussion of the triggers is anything that you use to open the position should be considered a trigger. When you open the Iron Condor, if you, of course, were looking for a certain range out of the money on the call or the put side, it's a range OTM. You used a certain delta, meaning that you only open this Iron Condor if the short option delta was less than 0.3 or less than negative 0.3, or if the delta on this short was less than 0.3 on the short call, however you use it. So out of the money range delta, with delta might be percent probability, or any kind of technical indicators you might use, considering a channeling Bollinger Band or something along those lines, if you use Keltner channels, anything like that. All right, that being said, when any of these or any two of these are triggered, that's usually when I consider making an adjustment. So if you had a position where you'd only open an Iron Condor if the delta on your short put was greater than -3, I guess we could say, then that would be a trigger. And you're worried about the market conditions, of course, of what we've seen. Okay, that would be a trigger too. And then also in general, I tend to look at what we call the 1% rule. And usually if the stock reaches within 1%, so in this case about $1, and we're almost right there. Right? So I sold the 103. $1.03 is 1% of 103. So if the stock fell and hit at 104.03, that might be my trigger point to consider rolling or adjusting the put side. Okay, so it's a good consideration to roll it right now. I have no problem with that, but what could we do is the question. Well, the 8 ways to manage the bull put in the webinar gives you a good idea of what's possible and what could be done. And we have to consider what your expectation is. If you think WIN is going to continue to move down further, well, then number one, it might not be at a profit, I understand. Number one, though, the first idea is just close the bull put. This might be at a loss in this case, but it gets you out of a further loss if WIN continues to drop and you don't do anything. So you could just close the bull put side and let it go down. I'm just going to jot this down side one. Close bull put. And we'll look at that in a moment as well. Okay. So we can close the bull put. 2, depending on the cost, again, if you think WIN is going to continue to move down and the market is going to continue to move down. Okay. Depending on the cost, you could buy to close just the short, buy to close the 103. It would be expensive, and you don't get the help of selling to close the 95 as the stock continues down. What does that do? Well, that gets rid of this short obligation. Oops, sorry, folks. Gets rid of the short obligation, and now you're left with a bear call credit spread that you could probably close right now for 90% profit of what you expected on that side, perhaps, is still falling. But it leaves you with a long put and a bear call. So if the stock continues to move down, the hope is this long call will continue to gain in value and help counter the loss you took buying to close the short. Okay, so just buying to close the short is another management technique. If you think the stock's going to continue to move down, that's what your fear is here, Denny, is it a good idea to buy to close this spread, liquidate this spread as part number one, and then just move down the strikes to, let's say, a 95, 8-point spread, 87 down here? Well, not really, because if your expectation is it's going to continue to move down, you're just trying to catch a falling knife. Okay, I'm not really a fan of managing a bull put spread or a bear call spread by just buying to close my current spread and moving in the same direction that's getting threatened. Because then usually that means I have to manage that one again and may have to manage it again as well. Okay? So I'm not a fan of rolling that part of the spread. I'd rather see you do something with this position. Manage it one way or the other to get out of harm's way on the bull put side. You might even be able to lower the bear call. That's always a little bit tricky because if win recovers, then you get lost on that side as well. Okay, so a third one, we'd consider maybe the pendulum adjustment, but I only do that if the stock is between the strike prices. We'll take a look at that in just a moment as well for managing this position. Okay. Now, there are other management techniques you could consider, but it's based on your expectation. If you think the stock's going to recover and move back up, that's not Sam's opinion. Sam's opinion, he commented and he says he still thinks the sell-off is coming again next week. And at this time, he's thinking buying straddles in VXX or UVXY are almost a no-brainer. Okay, but if you think the stock's going to recover, then do nothing. Is it worth it to roll down the bear call spread because you can close this one for a profit and get more premium? I don't think so if you think it's going to recover, because if it recovers quickly, then that side might get into trouble. Okay, so if you think it's going to recover, just leave it alone and see what happens. Is it a good time to roll or manage the position? Yes. Is it going to be expensive right now? Probably. Let's just take a look. I mentioned the first one. The original expected profit was $68. We talked about just buying to close the entire spread. Okay, so let's simulate what that would look like right now with the current prices. I'm going to add in our December options again, the 103 put and the 95, leaving the bear call alone. Now, what do I have to do? I have to simulate the opposite. I have to buy the 103 put I originally sold. We're going to sell the 95 put we originally bought. So I'm adding those two legs back in. 380 to 132. It's going to cost us about $250 to close this spread, which means we're going to be taking about a 180 loss. Okay, $1.80 or minus 9.1%. The bear call is still open. That's not shown here. The bear call is still open and is going to expire worthless. But right now, this would be at a loss of $180 or 9.1%. Why would I do this to this position at this time? It's to avoid a 10-point loss or an 8-point loss if win continues down the next 14 days, and within the next 4 days I find myself below 95. I'm not saying that's what's going to happen. I'm saying that that's what we have to consider. Why would I ever close right now and just take the loss? It's because I'm trying to avoid the larger loss. Instead of taking a loss of $8, I'm taking a loss of $1.80. And that's total. That does include the 68 cents there. Just buying to close the put I mentioned was going to be expensive. It's going to cost us $3.80. What is that going to leave you with? Well, let's take out that other selling to close the 95 put. Now we're left with this weird graph where, due to the debit, it is a completely bearish position. Okay? Infinite profit, but essentially what have you done? You've bought a 95 put at 312, which is currently, we saw, priced at 180, roughly. Was it 180? Yeah. So you'd need the stock to fall further. If it does fall further, it drops down in the next week to 99, it goes below 100, this 95 put might increase. How much? Let's take a look. Based on current volatilities, let's say it drops to 99.80 sometime next week, around the 13th, let's just say. What could we expect? Well, we know the calls are going to nothing. The 103s are countering each other, so it's still only a loss of 174. We're not getting that much gain. Where's my 95? Here it is. shows it would be up about 138 as time starts to decay out and it's getting closer, so you're losing time. This might not be a good idea unless you're really expecting the stock to continue to fall, Denny. Okay, just closing the short in that case. Again, I mentioned I'm not a fan of rolling down, especially if you think the stock's going to fall. I'd rather see you close it. We could close it and take that loss of 180, and then you may be able to roll down the bear call spread to lower strikes. But again, the risk with that, if I lowered it down to, say, the 120, 130, liquidate this spread now, roll down the 120, 130, get a new credit, that might counter it, it might not. Okay, so our loss was 180. Let's just eyeball it. Liquidate the bull put. Liquidate the bear call. It's not going to cost you much. 130 to 140, you're going to get, it might cost you 12 cents here, 8 cents, somewhere in that range. But then if you sold, selling the 120 and then buying back the 130 is only going to give you another 40 cents. Yeah, you can't get to the 180 range unless you're going down here to the 109. That's really, really risky, as you can imagine, because the stock's at 104, and if it rebounds, it's going to rebound likely quickly to go back to that point. The pendulum adjustment is a little different. What we typically do at the pendulum adjustment is if the stock is between, if the stock's between the two strike prices, another management technique I might consider is selling to close my long, the 95 put, and moving it up to, say, so 103, right? The 110 or the 111. Right? It's a pendulum. I'm swinging this over here. So what have I done? I've taken a bull put and now created a bear put debit, which will be profitable if the stock goes below 103. I've changed a bull to a bear with one roll, rather than closing the whole spread and opening a whole new spread. Historically, for me and in my own account, and for what I've suggested to others, this works best when the stock, you find yourself with a stock that's between your two strike prices of a bull put or a bear call. We'll look at the pendulum here. What would I do again? December 21st, expiration. We're going to sell that 95 put somewhere for about 120, 125. I'm going to buy a 110 for 730. Okay, that might actually work. I need the numbers to work out. So we sell to close this and get $1.20 back. We pay about $7 here, so we might only have a debit of $6.50, $6.60. But look, 110 to 103. It's a 7-point spread. If the stock stays below 103, I get $7 back. The bear call expires, so it's still profitable. All right, so I sell the 95, buy that. Yeah, confusing looking chart. Okay, but here's what happens. If it continues down, you now have a profit of 150, but you have a debit of 550 to do this. Okay, it's no longer credit, it's a debit, but you're looking to get the $7 back if the stock is below 103. If that is your expectation. That's the pendulum adjustment. You're just swinging along from 95 to 110 or somewhere in that range. I chose 110 as just a nice round number, 7 points away. And that gives us this good view here where you actually have a higher monetary profit above the 68 cents right now if wind continues down. What's the problem? If wind continues up, your max loss is now 1,550. As before, the maximum loss is only, what, 932? 10-point spread and the 68 cents. So you're almost not doubling it quite. And you may actually have to put up a monetary requirement there to cover some of the spread as well. Not the debit part, but the credit part. Okay, so that's the third alternative if you think it's going to continue down. If you think it's going to recover a little bit, do nothing. You're okay now, see what happens Monday. The stock falls Monday. Again, then we've got to consider, hey, do I need to close this short even though it's going to be extremely expensive? Do I need to close the whole side of that bull put just to get out of the way of the freight train? Maybe I can do this pendulum adjustment and still get a profit if wind keeps dipping down. You don't touch the short. Leave the 103 along where it is. You just move the long to convert your bull put credit to a bear put debit. Just an idea. Nothing's perfect. And that's only if you have the expectation the stock's going to continue to move down in the negative direction. Okay, naturally, if you think it's going to recover, I'd do nothing. In that case, I wouldn't worry, again, right now, let's go back to normal. I wouldn't worry right now about trying to move the bear call lower for more credit. Wait to see what the stock does. If it continues to fall, maybe you can do that. If it starts to recover next week, I wouldn't even think about it. If it continues to move down, though, we're going to have to do something with those bull put sides. I consider one of those three that I mentioned. Closing the bull put, expensive, but it stops you from taking a further loss. Buying to close the short, expensive even more so. But you can profit to the downside if the stock continues to fall. But you need a significant movement, and we saw that. The pendulum adjustment, right now it looked pretty good. You'd be able to do that if you got those prices at midpoint, close your 95 put, sell to close your 95, and then buy to open a 110, maybe a 111 if the numbers work out. Convert your bull put to a bear put debit. You've now got a bear put debit with a bear call credit. Win continues down for 14 days or stays below 103. You've got that max profit. Okay, so that's my thoughts there on the Iron Condor right now for WYNN. Let's take a look here. Let me add this not submit. Let me add this to one of our test portfolios. Okay, so I'm just going to click Add to Portfolio. Why not? Credit versus debit from the conversation we had a couple weeks ago. We'll just put in one contract of each to keep the math simple. Use these prices to simulate your 68-cent net credit. Okay, and there's the win. Of course, I'd set triggers here. On the portfolio for an Iron Condor, we see the total loss right now is about 255 there to liquidate. So that means the max loss, again, we saw is about 187. Okay, it would be the monetary loss. But anytime I'm tracking a position in the portfolio tools, I can go to position actions here, position analysis up at the top. That'll give me a breakdown of my current Iron Condor position. There's our win position again, sort of where we stand right now at market and based on midpoint, gain and loss. If the stock does stay right at 104.99 in 14 days, you still make the maximum profit. Okay, but it doesn't see any rollout opportunities right now. That's because it's pretty expensive to roll those puts and it would be at a loss. It doesn't look like it'd be a good idea to roll the whole Condor down to try to find the middle of the stock price again, meaning move the whole Condor out another week, but maybe doing a 95, 85 with a 115, 125, for example, the stock at 105 now, because it doesn't look like that would be a lot of profit. So remember, it's going to cost us almost the $1.80, the $2.55 to close it. Unless we get a $2.55 credit, it's not going to be worth it. And to get the $2.55 credit, you got to be too close to the strike prices. Won't have a good probability between. So that's why it's not showing any rollout opportunities. The pendulum adjustment might work, and that might show up as a rollout opportunity, but unfortunately it's triggered when it's between the strike prices, even though we saw that pendulum adjustment might work. Okay, but that's just another idea there of what you could consider. All right, so let's see here. Let me scroll down the list of comments and questions. Okay, so Sam says, good afternoon all, I'm sorry. He says, had a nice week, huge gains in his puts with, of course, Facebook, Apple, Goose, SQ, MS. Yeah, it's a shame you didn't try to play the opposite with me. I was in Ollie and those earnings were disappointing. I saw the stock fall from 91 to about 70 in the past 4 days. And it was a shame, too. Not a shame, really, other than the stock falling. But earnings came out Tuesday night after market. Of course, Wednesday the market was closed in honor of George H.W. Bush, number 41. And so I didn't know how it was going to react because there's a whole trading day gone. And come Thursday morning, stock opened up, I think, at 72, and then it's been fluctuating down since. I think it closed at 68. It was at 91 at the beginning of December. Well, I had an 85 put, and I was bulletproof at about 5%. So I haven't done anything with it yet because the market maker's not giving me the midpoint. He's not letting it trigger. And the bid, of course, is below intrinsic. It's a January 85 put. The bid is below intrinsic. The ask is above intrinsic, but not much. Unless I can get at least intrinsic or a little higher, I'm not going to liquidate because even if I hold it for the next 25 to 30 days, I'll still make a 5% profit. I'm not going to settle for less than that by trying to close early if he won't give me fair price. And Sam, of course, said he was selling calls at the higher pivot point there. He wasn't buying calls as well. And, of course, we all saw the nugget there doing well in the market. Of course, gold is going a little bit wild now with everything that's going on. Oil, of course, I believe took a hit today. I'm sorry, moved up today. My apologies. Oil moved up. Of course, the inverse oil has moved down with OPEC and Russia agreeing to cut down production. I think 1.3, 1.4 million barrels per day or per week. Maybe it's per day. I can't remember. So they're going to cut that going forward as well. And it's always a good idea, folks, to remember if you have positions that you were maybe playing, not playing, but I should say you were in, maybe taking a gamble on a market movement or stock movement, let's say a straddle, a strangle. You bought a put on SPY, for example, to hedge your portfolio. It's not a bad idea to cash out a half of those now with the movement that we've seen. I cashed out half of my VIX calls on Thursday, yesterday. Closed out half of my VIX calls yesterday, maybe a little bit too soon, but I still have the other half remaining as part of a portfolio hedge as well. So don't get too greedy in these cases. When you see a spike and you had something playing a volatility play, doing certain puts, I'm not saying close all of them, but it's good to take the profits on the table because remember when the market falls, it falls quickly. And if you miss it, it might go back to normal. Now, I'm not saying we're going to see the VIX go back to 16 or 12 anytime soon, but it might drop down to 18 on Monday if there's a little hiccup. And then if we still see it sell further after that, it might move back up. It's very hard to play those sometimes. Sam says one of the best stocks he's seen, of course, is Tesla in the last few days due to that as well, and puts on SLB. Okay, you did see Ollie, but you had too many puts already open. Okay. Yeah. All right. So, okay, you did see Ollie, and then you mentioned it's trader's market as well. Okay, I'm going to share something with everyone real quick. Something interesting that I had. I'm going to post a blog about this weekend. I didn't get to it today. I've got a couple other recordings to do for webinars coming up next week that we're going to have. I'll get those posted. You guys can see what webinars we're doing next week soon too. But I had a coaching session today, and the customer wanted to know about SPY. And of course, we've been dropping here. SPY is actually down more than this, but at the time when I was working on this ideas for this coaching session, SPY is down 4.5% for the year. When I started this test, I'm going to show you in just a moment, January 22nd of 2018, the Monday following January expiration, first standard expiration of 2018. So on January 22nd, I believe SPY was around 682. So we've dropped another 6 points here today, another 2%. So it's probably down about 6% total for the year. And it was a little bit lower than that. It's almost a wash, actually, over, not 2 years, I'm sorry. Yeah, over 2 years it's almost a wash. Here was the situation. Let's just take a look. I'm going to go big charts. On the coaching session, the customer wanted to know about just doing monthly covered calls on SPY. Is it a good idea for a retirement plan? Well, the concepts are interesting. Okay, so at the beginning of January, we were right here at about 270. Okay, so we're a little bit, SPY is down for the year, of course, right now. We kind of opened at 270 right at the beginning of January 2018. On the 22nd, we were right about 282, right in this area here. So we're down 4.5% at 269. It's probably down about a total of 6 or 7% now from that point at 282. So his idea was that even though it's a wash, that you could enhance this by maybe 1 to 2% each month, so we still should be able to make 24%, 12% over the course of the year using SPY covered calls. Well, unfortunately, that's not the case, is it? Because you still take the hit on the loss on the underlying, and unless you hedge this by the amount of the underlying over that 8-9 months, and there's little hiccups in here all along the way, there's been 5 significant declines in the last 12 months, haven't there? 2. This one, I consider that significant. I remember that one. 3. This one wasn't significant, but it caused a problem. And there's 4. And there's almost 5, right? October, and there's almost 6. Okay, so it's been half and half this whole 2018. Despite, everything you read, that, hey, the market's up, the economy's doing great, jobless grades, things are going well. It's been a wash this year. And we all know, all of us as investors know, that some of those indicators that are talked about aren't really a good measure of the economy, and the market as itself may or may not be a good measure of the economy. But look, in general, this is a tumultuous year. There were 6 individual cycles of significant downturns. Half of the year. Half of the months of the year were down. A little bit more than that, actually, if you look at the one extended one for October. And if you say that this November was just trying to rebound, but then the fall right after that again was related to the same thing, that almost lasted 2 months, right? I mean, you could argue that, but we don't need to argue that as well. That's just where we are. Okay, so long story short, just wanted to show you that that's where we were. But of course, we go back 3 years, or even 4 years, we know that 2016 to 2017 was essentially into the first month of 2018 was essentially straight up. It was about a 34% gain in SPY over that time after that hiccup in 2015, beginning of 2016. So that was pretty significant. So if you were chewing covered calls out of the money or at the money over a 4-year period, you should have been able to capture most of this 33% gain to withstand this, right? Not quite. Let's take a look at what we did here. And this is going to be a little bit different. I don't have this in a slide format. I do apologize for that. But I'm going to open in 1 second here. Oh, I'm sorry. Let's grab the wrong thing. Aha, there we go. All right. And okay, so just if you were curious, all right. Okay, so what we saw, first I'll take the out of the money because you think, okay, I'm going to sell covered call positions on just SPY. I'm going to go out of the money with positions that maybe have a 40 delta or less, or 40% probability or less, and look for a good return. That's the search I used in Power Options. I created a search looking just against SPY 1 month out in time. 40% probability of assigned or lower, which kind of equates to a delta of 0.4% or lower. Minimum 0.3% return if unchanged, meaning the yield just against the stock price had to be 0.3%, and a minimum 1% return if assigned. Why so low as 0.3? The reason why is if we looked at a chain in SPY right now, I could go, I think when we looked at it this morning, this SPY was at 267. We looked at a 282 call for January, 15 points out of the money that was worth about 190. That's because the implied volatility is high. The beginning of January of 2018, back in this time frame, over here, remember when the VIX was at 11, you couldn't get 0.3% going 15 points out of the money on SPY. You couldn't get $1.94. You couldn't get $1.95. You were getting maybe 60 cents, 70 cents on a stock around 220, 230, 240 by going 15 points out of money. Now, so you'd have to sell at this point the 270 or the 271 to get 40 to 50 cents back at the beginning of the year, just a couple strikes out of the money. Okay, so that was what I was looking to do, is find a good range out of the money that was safe considering the implied volatility, but at the same time, I had to find results. Now, if I ran a search back from the beginning of the year on that was looking for a return on SPY of out-of-the-money calls of 1% minimum yield and a 4% return if assigned, I wouldn't have found any positions with a 40% probability in January, February, March, April. Saw one around April, saw one around September, right before the October decline. Saw one in October because the volatility was up, but it was only 2 covered calls over the 11-month period. In any case, so that out-of-the-money one with, again, SPY down 1285 from 282 to 269. That was of this morning, yesterday of December 6th, excuse me. It's down another 2%. We saw that. So it's down 4.5% for the year. It's actually 7. But the covered calls would have been a loss at 2.1%. The out of the money would have still resulted in a loss. You hedged the loss by 2.4% over 2018, but it still would have been a loss. 56% of the time you had winners, meaning they got assigned or you had a small profit. Well, that makes perfect sense, doesn't it? We just showed how there were about 6 significant declines over 2018, 50% of the time. So covered call winning track record of 56% makes perfect sense in that type of market, doesn't it? Well, is it better to go at the money? Well, you would have hedged it more, 0.8%, a loss of 0.8% instead of 4.5. Still would have been negative. Average win is 1.1%, average loss 2.5% with the hedge in place. And then the in the money would have been positive. Selling 2 strikes in the money with a probability of 60%, average was about 67% probability assigned. Okay, delta of 0.67 around if you want to look at it that way. 78% were profitable, but of course you're in the money. So the average winner was only 0.6% and the loss was negative 1.3. Over 4 years, including that 33.5% total gain from 202, January 20th, 2015, to 269.84 in 2018, the out-of-the-money covered call results over 47 months, roughly 45, 46 trades, total 7% return. Why? Because it's a covered call. Those times when SPY jumped 8 or 9 or 10% in a 1-month period, you got assigned for 1.7 average. You missed the other 6 or 7 point moves. And you say, oh, well, roll. Well, you've got to pay the 7% intrinsic to buy back that call to roll to the next call, so you're not getting that 7% back. You're just increasing it by another 1.2, 1.3% by rolling. So whether you get assigned and buy back in, or whether you pay the intrinsic value to roll the out-of-the-money call that's now in the money because the stock moved up 8 or 9%, you're only gaining another 1.2, 1.3%. You're not gaining back the 10% the stock moved. Okay? And that's what happened. So 66% of the time we're winners. Well, that makes sense because we saw of those 4 years, pretty much 2 of them were directly lower left to upper right. One of them was only 50% win. That's the most recent one in 2015, was a little hectic as well with a big drop right before the start of 2016. But out of the money covered calls on a security that grew 33% over a 4-year period is about 7% total, 1.75% per year with out of the money covered calls. Same rule, 40% probability or lower, delta of 0.4 or lower. At the money returns 6.1, right at the money. I was looking right at the money, looking at 1 strike in, 1 strike out of the money, but the one that had the highest percent fund change, that'd be the closest to at the money, and that was 6.1%. Naturally, the number of winners increase, but it still had a lower return overall because you didn't get the capital appreciation from being out of the money. In the money still was okay, 91% winners, but again, you're only making 0.5% when you're right and only losing 1.6 when you're wrong from the higher downside protection. One thing that doesn't take into account is the dividend. On average, SPY is a 1.8, 1.85 dividend yield. The average over the last 5 years is 1.88, so I used 1.85. So the 1-year return for out of the money still would have been negative, but only 0.25% if you consider that you took in the full year as well, and 1.5% positive for at the money and 2.75 for the year in the money. Why am I showing you all that? Well, of course, it increases here. That out of the money would have been 8.85 with the dividend, okay, average per year. So it jumps up to about an average, really, of about 2.21% per year. Okay? Now, why am I showing you all of that? Well, it's simply because, and that number's wrong. This is the wrong one. I'm sorry, this needs to be corrected. I just saw that. I think someone else did too. In the full write-up, I have this better presented. It's 7% average over 4 years, and you would have gotten a dividend of 1.85 every 4 years. So the average comes out this is wrong. It was 1.85 plus 1.85 plus 1.85 plus 1.85, and then the yearly came out to be about 3.25 per year. Okay, so that's out of the money covered calls, 4 years, just on SPY receiving the dividend, average of I think about 3.25 or so per year. Why am I going in depth showing you this? Because if you ever had the question, is it easier to just sell covered calls on SPY than to try to use the power option search or use the picks of the day that Ernie created in covered calls after extensive testing and so forth? I don't even have covered calls up here. It's funny. And I'm not saying this is really the time for covered calls. But what I just showed you gives you a gauge of what you should expect if instead of looking for new covered calls on the search based on bullish criteria, what we've done with the picks of the day and more, if you just wanted to focus on SPY as a covered call alternative, what will your expectations be? Even in a cycle where SPY went up about 33%, your expectation should be about 2.7 to 3% per year. That's it, with the ups and downs. And even over a 4-year period where you saw a 33% gain, then had a year of 50-50 up and down, and before that another 50-50 up and down as well. And SPY being up 33% over that total time frame we looked, the 4 years, you're only expecting about 3% per year with a covered call strategy on SPY. That just gives you an idea. Does that solve your trading needs? Okay. Sam says if you hedge with puts, it's okay. Yeah, and this is just a straight covered call approach to use as a comparison against it. Now, I'm not talking right now, Sam, I'm not talking about comparing it to doing a collar with selling the out-of-the-money call and buying a put and then rolling the put and manipulating the put with the falls, getting the call back to hedge it. You know as well as I do that if I buy a stock, I'm only doing it as a married put or as a collar. I don't do covered calls anymore. I'm just showing this as an example of what to expect if over a 1-year, 4-year period, with the kind of markets we'd have, you just did out-of-the-money covered calls on SPY and collected the dividends, what would your rough expectation be over the long term? Okay. All right. Okay, so this prompts a comment from, is it Jim? It's Jamie. It's Jamie. I'm sorry. I just saw the side, the first 2 letters actually. So it's Jamie. I thought it was James. It's Jamie. Jamie says, well, I trade collars, but I don't know if this is the right market for collars. Okay, what is a collar, of course? Well, collar is a standard approach similar to, oh, sorry, that's not where I want to be. One might use with a covered call. But instead of just buying the stock and selling a call, we're going to buy an out-of-the-money put as well. So we're selling the call here, buying the put here. When I structure a collar, I'm still looking for about a 2.5% yield if assigned or higher. And that's about 20 to 30 days out in time, sometimes 14. But if the stock collapses, moves against me like we saw in October, recently in the past few days, I'm trying not to take a risk of more than 4% to the downside, which is guaranteed. It's better than a stop order. You probably wouldn't do this, but if I just bought Ali right before the earnings at 88 and then woke up Thursday morning and saw it 72, I'm at a 16% drop on the position, close to probably about 20% decline. Okay, if I put a 5% stop order, that got violated when the market opened at 72. I got filled at what the market could give me, which is 72. I bought the stock at 88, bought an 85 put for $2, and the stock fell to 72. I get out at 85. Yeah, I paid $2 for that put, but that's to stop a $16 bloodletting and only take a $3 loss plus the premium there of the $2, which I would have hedged with a short call. But that's not a strategy for earnings either. So is this a good time for a collar? My answer is yes. If you're looking to get in stocks now that you feel are depressed in price, if you think those stocks are going to recover or even be kind of neutral like an Iron Condor. Sam already mentioned that he feels the sell-off is going to continue next week. Okay? He doesn't think now is the time to do that. I'm just going to say that off the bat. That's his take. That's fine. But if you're looking to get into a stock at this time, a collar would be a good approach. And you could just set up the search to find what you need. Let's just go to see if I can find something here. Okay, well let's take win for an example. I'll just take win on the custom spread tool. So again, we know win is at 105. What might be a good combination for me if I bought 100 shares now if I thought win was going to recover? I don't know if this is Denny's as well. And Sam, I'm getting to that. I'm getting to that as well. Okay, so win right now is at 105. I might go out to December 21st, 14 days. I may also go out to January at 42 days. Seems a bit far, like December 28th, but let's just go to standard here. So give myself some good upside room. I might maybe sell the 106 for 415. I'd really like to buy the 99, but that's a little bit far. Only 6 points, and I'm getting 2. Okay, I'm going to buy the 99. Okay, so we're going to sell the 106 and buy the 99. It's a 7-point spread. Reason why I did that is I'm going to get about 420 for selling this call. So I was looking for the put that's around 210. Really, it's the 98, but we're going to use the 99 here. That's why I chose. I could use the 98 too. It would be a higher risk, but I get better premium. That's good. Look at that. That's right in the range of what I would look for in my standard collar positions. I'm not saying that this is a good play. I'm not saying this is what you should do, but this is the structure I would use. A percent if assigned of 2.8% for 14 days if the stock recovers and moves above 106. Okay, so $292 or 2.8% off the $10,000 investment. But even if the market continues down and I'm wrong, it drops below 100, the most I can lose is 4% or 409. That's risk control. Okay, and then I'd make sure that this 409 doesn't represent more than 2% of my total portfolio value. Okay, so if I did 5 contracts, it'd be a risk of over $2,000. Well, I'd have to make sure that $2,000 does not represent more than 2 to 3%, 2% or so of my total portfolio value. Okay? So even if I take the full loss, I still have 98% of what I started with monetarily. That's controlled risk, and that's why I prefer collars over covered calls and have for about the past 15 years. I've been doing collars consistently, and I do the married puts too also in addition. These are what I call standard collars, same expiration, at or just out of the money call, out of the money put. Still looking for the same type of return you'd look for in a covered call, 2.8%, 3% return if assigned. It's more skewed bullish because I need it to move above 106 to get that at 104, but then I've got the guarantee exit much better than a stop order as well. Okay, so that's a good play. If you personally feel that maybe after the next few days or so the sell-off's done and you think it's a time to buy stocks at a discount, but you want to get some premium and you want to have a good hedge, the collar is the way I'd go. Married put is a good approach too. I'm going to be teaching you all about that in the next couple of weeks, different webinars there for power options and radioactive trading as well. But that's that approach. Sam feels that right now is not the time to hold stocks. You want to buy straddles. Well, I agree, and to a point. What does he mean by that? What Sam means is rather than attempting to do a directional play, he and other investors feel that buying a straddle, same strike price, a call and a put at the same strike on the same stock with the same expiration, or possibly a strangle for a little cheaper price, maybe with an out-of-the-money call, out-of-the-money put, or you can use in-the-money as well. So as the market swings, you're trying to take profits one direction or the other. It's a good strategy. It's worked out well for Sam for the past year. He's been sharing us through all of our recorded webinars, different things he's been doing and adjusting and rolling, other positions in addition to the straddles. Part of the problem is now, as you know, is with the recent decline that we've had, everything has gotten extremely expensive. All right, so if I bought the out-of-the-money call for $423 and bought the out-of-the-money put as a strangle, it's a play that's only $600, but again, that means that my upper break-even is going to be at 112.50, not too far. My lower break-even is going to be at 92.50, pretty far down. Okay, so a straddle might be buying at the same price, and I wouldn't do 14 days. I'd go further out to January to give more time for the stock to bounce around. But if I go right at the money with a straddle on most stocks right now because of the increase in volatility, this is going to cost me $14, $15. Think about it. That's a 15% investment of where the stock is, and the lower just makes the lower break even deeper. we get a lower break even and a higher upper break even because of the cost. And that'd be a 120 for the upper break even. As you can see here, 89.45 at the lower break even. 15 points down roughly from where the stock is. 15.55. Okay, so, but what happens? Well, if the market continues its sell-off on Monday, it drops down to 100. Well, you may be able to manipulate this put, take some profit off it and move the call down. And as it recovers and goes back up, then you can do the same thing with the calls. It's also time consuming. Rolling and adjusting, moving those positions is a little bit time consuming. Part of the collars that I like is that I'm just planning it to go above, and if it does go below, it's okay, I'm out. I'll only really manage if the stock expires between the strike prices. Once I get assigned on a collar, I'll just look for a new collar that matches my criteria. I won't try to adjust win and continue to roll it. If I'm long-term bullish on win, I'm going to use a married put, not a collar. Maybe a straddle longer term, maybe. Okay, but that's not the same type of structure, and it does take on risk. You have to make sure now that the monetary amount, the contracts you buy here, that monetary risk doesn't represent more than maybe 3% of your total portfolio value. So if it does stay the same and volatility collapses, you don't want to take that full loss of more than 4 or 5% of your total portfolio value. You don't want to put 10% of your portfolio into a leveraged straddle is what I'm saying, right? That's not going to be good. Okay, so position sizing is important, but that's sort of the structure. Another thought we could consider is, in this case, I'm sorry, I had mentioned that, if you wanted to look for a way to get into the stock at a discount now that's depressed, someone says, why not just sell a naked put? Well, because if I'm wrong, it has the same risk-reward profile as a covered call. If I go 5-10% out of the money, if the stocks or the markets continue to pull down and we see another 10% drop, okay, so I get assigned at that point, but if it continues down, I'm in trouble. You might consider a bull put spread in that scenario, okay, but not as a real bull put. What do I mean? I'll go out far term. I go 10% out of the money, sell the 90 put for $1.58, then buy the 80 put for about $1, maybe a little bit more. So we'll go midpoints with these two. It's a bull put spread. It's a 10-point spread. Yeah, so we're getting about a little bit over $1, $1.12, $1.13 credit. Why do the bull put? Well, in case it's sudden and the stock falls, monetarily, well, you're risking 100% of what you invest, but monetarily you have a controlled risk. If I just sold the 90 put and the stock fell to 80, I might be down 10 points. Here I'm only down 8.86, maybe comparing apples to oranges, as no one wants to take either loss with that scenario. But this might be a better approach because you might be able to get in the stock for a cheaper price, but at least you have the hedge in place. And I don't really delve into the ratio back spreads unless I'm using it for repair as well. Okay. Yeah. So this is just if you were looking to get into stock at a discount, that came from my comment of now that the market's down, if you think it's going to recover, picking up stocks at a discount, I would do it as a collar if you were going that route. The comment then came in and says, well, if you want to stock at a discount, do a naked put. Not sure if this is the market to continue doing it, just like I'm not sure if this is the market to start doing covered calls on SPY. I gave that review based on to show you what an expectation would be over the last 4 years. If you did do just covered calls on SPY, you're looking at about a 6-7% return total over a 7-year period, not including the dividend, average of about 1.82% average per year. Okay, that's what we were looking at there. All right. So those are just some thoughts here about doing it in this case. And oh, okay. And the comment comes in that says, I'm sorry, when to buy and sell is also important in this market. That's true. And that's why I had mentioned earlier that it's best not to get greedy. When you see these downturns, if you had a hedge that was profiting to the downturn, whether you bought puts on SPY, maybe you bought some puts on NDX, QQQ, for example, or you bought calls on the VIX or UVXY, maybe shares of UVXY. With this type of decline that we've seen in the past few days, it's typically best to take that profit potentially off the table. Now, half of it, some of it, sell half of the hedge, take it now, because if it recovers, the volatility will drop and you'll start to lose that very quickly. It has the potential to lose some of the gains very quickly. So you want to try to take the profits on those hedges when you can. Sure, the market could fall further. I didn't say close all of them. I'm saying closing maybe half of them or so to leave those in positions in place. What we haven't seen yet is a Bollinger Band breakout confirmed to the negative. We pretty much did in October, and that continued down, and we saw some recovery. But yeah, for me, the MACD is declining. RSI is steeply declining. We've broken below the 20-day moving average. Couldn't fight against it today after the decline the other day. And we're getting close to that lower Bollinger Band. So right now, I still feel that there's a lot of weakness. Okay, yeah. To tell you the truth, Sam, that's sort of Ernie's goals. Sam, they made a comment, said your goal should be 10 to 15% gain and 5 to 10% loss. That's exactly how Ernie treats the radioactive trades, his radioactive trades that we post on Fusion. He's trying to average about a 10 to 15% gain on his positions, holding those long-term married puts for maybe upwards of 6 to 8 to 10 months. But he doesn't take a loss of greater than, I think, 4 or 5%. Average over his past 5 years of doing that technique. 5 years? Wow, 10 years almost of doing that technique. Mine's a little bit less. I try to keep my losses around 4%, and I target about a 7.5 to 10% gain. It's a little bit lower there. But that's about Ernie's average, and the same thing he looks for that you mentioned, Sam, is looking for 10 to 15% gains on longer-term positions as opposed to what you're looking at, and an average as well, while at the same time controlling risk to between 5 to 10% as well. And he's got the controlled risk in place because of the put options, although sometimes he takes positions that have a higher risk than I do. And that's fine because he actually does a little bit better. So what I'm talking about here is the Fusion subscription, of course, at Radioactive Trading, where we follow just the married put techniques. You can follow our trades with the open tracker and view the married puts we would open if we were opening a married put position today. I just wanted to go to Ernie's track record, Sam. So over the past 10 years or so, since Ernie started posting his trades in the Fusion account, let's just get this to come up here. Here we go. Yeah, so you can see right there, over 73 trades in the past 10 years or so, his average win is 10.5% and his average loss is 5.3%. So that sort of follows exactly what you're saying. I've seen this as high as 12 and this as low as 4, but it usually stays around this area. Mine's a little different. I use lower price stocks because of my account size. So since 2008 when I started doing this, but I had a lower account, so I don't have as many trades. I only have 64. I'm at 7.1 and 4.8. And that includes everything that I've closed this year as well. Doesn't include the 3 open trades. I have 2 open trades. I'm sorry, Starbucks and Ollie that I have right now. Ollie will be a 5% gain, so it might drop this down a little bit lower, but the average loss is there. So he's doing a little bit better than me because he stays in positions longer to try to milk them to get to that 10% profit, even if it takes an extra 2 to 3 months. And many of positions are 14, 15, 18% gains. And both of us usually bulletproof a third, a little bit more than a third. It's not quite half, but a little bit more than a third of our positions every year. Ernie and I end up being bulletproof. So I was bulletproof in Canada Goose. I was bulletproof in Penn, the positions I opened this year. So the positions open this year, there weren't that many, 1, 2, because we're down market 50% of the time. And so anyway, 1, 2, 3, 4, 5, 6, 7, 8. There's 9 total positions. Canada Goose, Penn, Ollie, 3. And that's it, I think, right? Oh, Planet Fitness was, but that doesn't count because that was open at the end. That was open in August and closed in January, but that was that. So if you include Planet Fitness, the 1, 2, 3, 4, 5, 6, 7, 8, 9 positions open, 1, 2, 3, 4 of those 9 were bulletproof, meaning I had no risk at one point or the other as well. You know, sometimes I like to brag about my losers. Why? Look at Polte. This was not 2.8%. This is 1.8. I took a 1.8% loss on Polte, but it was down 33%. But then Penn, of course, is down 33%. I was long stock the entire time, made a 10.3% profit. Okay, that's not exactly great, but at the same time, and I see Sony, I just played this one wrong. That was a lesson to myself there on that one. All right. So, well, ladies and gentlemen, it's 5:32 p.m. Eastern Time. We still have about 18 to 20 people online, but I don't see any other questions that have come in. I've gone over Sam's comments. We talked to Jamie. Let's see there. We handled Denny's question right off the bat, and I shared with you my thoughts on SPY, which I hope to post as a blog this weekend, latest by Monday, because I really got to buckle down here and get some other information for you guys out there. There'll be a couple short videos you'll see coming out soon, too, all probably by Tuesday, and then you'll see some webinars next week also. But I don't see any other questions coming in. If you have any last-minute questions, go ahead and send them our way, my way, I should say, so I'm the only one online with you guys right now. Oh, of course, yeah. So there we go. Okay, so I just wanted to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge, and maybe acting as a second pair of eyes on some of your situations. Any stocks, option strategies discussed today should not be taken as direct trading suggestions or recommendations. And I've explained that in depth as well, that I'm not saying this is a time for covered calls or that this is a time for callers. I'm saying that if your expectation is Y and you're considering buying stocks now because you think the market's bottomed, I'm not saying I agree with you or disagree with you. I'm saying that I would open that long stock as a caller or as a married put right now. I wouldn't do it as a covered call. I don't know if I'd be doing a naked put right now, and I would never just buy stock outright without some form of hedge. I'd only use a standard call or a married put right now. Options do involve risk. We talked about that with the straddles. Anytime you use a leverage trade, it's a good idea that you have that straddle or strangle so you can move one direction or the other as the stocks move up and down, but you can't let that leverage straddle, especially if there's a volatility collapse, if the market does start to recover, you can't have that represent 15 to 20 to 30% of your portfolio in one position because you could get slaughtered. Even though it can profit in both directions, you can still take a huge loss. So be always wary of that. Position sizing is key. Yeah, and managing the calls and puts when you're doing that, and that's what Sam's been saying. He's been doing extraordinarily well with the straddles, buying a call and buying a put about a month or 2 months out of time, and then selling premium against it as the stocks move one direction or the other, and rolling and adjusting the longs up or down depending on what's going, and taking his profit out of the calls and puts as the market swings. If you haven't done so yet, you want to take a look at those portfolio tools we looked at today. You want to take a look at the search tool we briefly looked at for the covered calls or for any strategy, or just use your own manipulation with the custom spread tool. Remember, you can take a 14-day free trial at any time. Just go to powerup.com, put in your name and email address. You'll have full access to the site for 14 days. Subscriptions after that start at $40 per month. Then, of course, we do have 20-minute delayed service at $60, and we do have a real-time service and the historical tools as well. They have data that goes back to April of 2006, historical stock and options data. Other free stuff, well, you'll hear some emails from me hopefully this weekend about seeing some blog posts there. You can always check out the blog, blog.powerup.com. I mentioned that webinar, the 8 ways to manage your bull put spread. You can see that anytime. Just go to powerup.com/webinars.asp. It's actually a public page right now. You don't need to be a trial member or have a login to access it. Under the Options Strategies tab, you'll see that webinar there, 8 ways to manage your bull puts. You can also check us out on YouTube at any time under User Power Options. If you do think of any questions later on, anything later on in the weekend or before the market opens, remember, send me an email at any time to support@powerup.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And if you're on your trial or a subscriber, you can schedule a coaching session at any time, and that's essentially a 45-minute phone conversation with myself or Ernie, walk you through the tools on the site and answer any questions that you have, just as with the discussion I had this morning when the customer scheduled the session Thursday evening and said he wanted to talk about what it would look like for doing out-of-the-money covered calls over a yearly time period. Well, that's why I did that test using the historical tools to see what he would expect. And that's what you should expect in a coaching session as well. We'll answer your questions there and go through anything as well. All right, everyone have a wonderful weekend. Sam says have a wonderful weekend and come back strong and get ready to hammer the market on Monday. I'm surely going to look to do that as well. I hope all of you have a fantastic weekend. I thank you all for your questions and for joining me this afternoon. We'll get this webinar posted for you hopefully tomorrow, and we'll send everyone an email letting you know that it's been archived. You'll be able to watch it on the webinars page or on YouTube as well. Take care, everyone. Good night. We'll see you soon.